Every Canadian housing downturn feels different, but with warning signs before it happens. They're always the same. Why do prices feel safest right before they fall? And why, when we look back, do we always say the signs were obvious, why didn't we see them? If you're noticing affordability stress, slowing sales, and rising payments, you're probably not paranoid. You might just be early. Real estate is complicated, right? Immigration, zoning, government policies, construction costs, there's dozens of factors. But if we zoom out, three forces really drive the housing market here in Canada: interest rates, wages, and consumer confidence. Now, when we talk about interest rates, Canada is unique because most mortgages reset every 5 years or less. So when the Bank of Canada hikes rates, it doesn't take decades to be filtered through like it does in the United States. It hits fast and it hits hard. In 2022 and 2023, when the Bank of Canada hiked aggressively, affordability was crushed almost overnight. We saw prices correct from around 15 to 20% in Ontario and BC, not because homes got worse, but because financing got more expensive. When we explore wages, well, that one's a bit more straightforward. Prices have outpaced incomes for decades. In Toronto and Vancouver today, over 60% of the median household's income goes towards housing costs. That's not sustainable. At some point, wages are going to have to catch up or prices are going to have to stall and fall down. When they don't, buyers retreat, and in some cases, forced sellers come to the market. And then, of course, consumer confidence. This is the last domino to fall. As long as people believe housing will keep rising, demand holds steady, even if it stretches affordability. But once that belief breaks, demand slows even before pricing moves. It's classic psychology shifts from fear of missing out to fear of buying too high. Now, let's take a quick trip back through history because Canada's housing market has seen a lot. In the 1980s, interest rates hit 20%. Imagine that today. Imagine the default surging and the people who stretched too far losing their homes. In the 1990s, we had a brutal recession and high unemployment. Prices stagnated for almost a decade. People bought homes, but they didn't see any growth for years. In 2008, the US housing market collapsed, but Canada held up. Why? Well, we had stricter lending rules, and we didn't have mortgages set up with no income, no job, and no asset qualifying. But confidence here still took a massive hit. And then in 2022, 2024, the most recent in memory, the Bank of Canada's fastest rate hike in history caused market corrections in Ontario and BC. We saw drops of 15 to 20% in record time, and investors who banked on cheap credit got caught. So if history teaches us the patterns, what are the warning signs this time? 1, debt servicing ratios. This is the biggest predictor in Canada. It's basically how much of your paycheck is eaten up by your housing. Right now, renewals are pushing households right to the edge. If more families are putting 50 to 60% of their income into their housing, that's a stress point and it can cause friction in the economy. The second thing we look at is price versus wage. Anytime prices climb faster than income, it doesn't last. Either wages rise or the market cools. Right now, in many cities, wages are not keeping up in pace. The third thing, risky borrowing. Now, we don't have US-style subprime loans and we don't have the same rules as them, but we have our own Canadian risks. Buyers scraping by with 5 to 10% down, pushing themselves right to the brink of qualifying, where if payments go up, they're kind of, up the creek without a paddle. In those cases, variables and stuff are something you'd want to deeply consider avoiding. Or pre-construction condo assignments where investors try to flip before the actual closing. We've seen a lot of problems with condos in Vancouver and places like Toronto, where people bought the pre-built condo and now it's not worth what they bought it for, so they can't get the financing on it. There's a lot of risk with that. Then, of course, variable rate fixed payment mortgages hitting trigger points. That's where you have a variable rate mortgage where your interest rate fluctuates with the prime rate of Canada, but your payment stays the exact same. As prime goes up, you just end up paying less towards your principal, and if you hit your trigger point, that means you're not even covering the interest. A prime example of this is where you can negatively amortize your mortgage. You come up for renewal thinking you're going to have a 15-year amortization, but effectively you have 24 years left on your mortgage and you're still renewing it 15 years. That's where we see people's payments go up so dramatically and pretty much double overnight. The fourth thing we look at is, of course, inventory. This is a lagging indicator, but a powerful one. Rising unsold homes means sellers are losing power. Once that happens, price cuts generally follow. And here's the thing about all this. Canada isn't just one market. It's a bunch of regional stories stitched together. Toronto and Vancouver, the most stretched price-to-income ratios are off the charts. This market tends to lead both up and down. In the prairies, more tied to energy, less bubble risk, but swings if oil prices shift. Then Atlantic Canada. Pandemic boom towns like Halifax are softening as remote work platforms fade. And then Montreal. Slower, steadier, less of a boom and bust, but not immune to rate and confidence shifts. So let's shift from the doom and gloom talk and go more towards empowerment, because housing downturns aren't about fear, they're about being prepared. Here's what I would recommend. First, buy within your means, especially with renewal risks ahead. Stretching at today's rates can backfire in 3 to 5 years if rates go up. Now, rates are scheduled to decrease, and that's what we expect to happen, but as we've seen in recent years, there's no guarantees of that. There's no guarantees that rates are going to go down. So if you are stretching yourself right to that limit, you're going to want to rethink it, right? It's just smart thinking ahead. The next, avoid speculation. Pre-construction condos or bidding wars, well, they look tempting because they get you into a property that you expect to be able to sell at a higher price, but they're the riskiest plays in a correction, because if prices go down and you paid too much, you have to eat those losses. And if you have financing on the table that you can no longer attain, well, now you're putting yourself into major levels of risk. Another recommendation I would have is to not overestimate a 5-year fixed. In Canada, 5 years isn't forever. Renewals come fast, and the rate environment could look very different when you come up for renewal. As mentioned, we expect rates to continue going down, but there's no guarantee. My best thing I do with this is keeping tabs on stuff with an annual look over of people's mortgages, including my own, to make sure that what I have works for me, and so I know exactly what the trends are doing so I can adjust and pivot as required. Another thing that I recommend is building financial resilience. Aim for 3 to 6 months of an emergency fund, and if you can push further than that, I highly recommend it. You also want to make sure you're paying down high interest debts, credit cards, car loans, lines of credit that aren't secured, things like that. These safety nets matter, especially if incomes slow or go down. I would also recommend exploring diversifying your wealth. Don't put 100% of your net worth into a single property or a single investment avenue. Housing is powerful, but it shouldn't be your only plan. You should have alternative options when looking at building wealth. You never want to put all your eggs in one basket, because if that basket falls down, you break all your eggs. And then, you've got an omelet full of shells. Trying to think of something to say here, but I got nothing. Honestly, every downturn looks a little different, but the signals are always there. Rates, wages, confidence. We've seen it in the 80s, the 90s, and in 2022, and those signs are kind of flashing again. But here's the perspective. Downturns aren't the end. They're part of a cycle. And if you know what to watch for and you protect yourself, you can even find opportunities within these times. So now I want to know what you think. Are the warning signs flashing in your city? Drop your comments down below. I'd love to hear what you're seeing on the ground. And if you want more updates on where Canadian housing markets are heading, hit subscribe. And if you're worried about your renewal or planning to buy, let's talk through the numbers. I'll put the link down in the description below. My name's Myles Nowik of the Nowik Mortgage Team, powered by Andy Mortgage. Thanks so much for watching. We'll catch you on the next one.